what I offer is not just in terms of cost seg or title. What I offer is in terms of being there for you and helping you out. Anytime I see on LinkedIn somebody post off-market deal, I'll tag one of my people that I know is looking in that specific area. So I really try to go ahead and give back, and I'm really super excited for the years to come and to see what else and how I will transition into a bigger role.
Welcome to the Plan B CRNA podcast. I'm your host, Bobby Jones, and I'm so excited that you're here. The Plan B CRNA podcast is the only show made specifically for nurse anesthetists who are exploring options outside of their traditional career paths. This is the place to expand your mind and your goals as we uncover new ways to produce side income together. Join me for some honest, unscripted discussions with other CRNAs who are transforming their financial lives. This episode is brought to you by On-Call Capital. On-Call Capital is dedicated to educating CRNAs and other healthcare providers about investing outside of the traditional stock market. On-Call Capital also provides opportunities for you, yes, you, to create passive income and generational wealth while also lowering your taxable income through investments in the apartment and alternative investment spaces. If you haven't hit subscribe yet, make sure you do that right now so that you don't miss an episode. Thanks so much for joining me today. And now, on with the show. Welcome to another episode of the Plan B CRNA podcast. This is one of our special guest episodes, and today we're going to be covering a topic that should be near and dear to the heart of every real estate investor. Now, as an accomplished cost segregation and title provider, as well as an avid real estate networker, Isaac Weinberger has the ability to connect people from all spaces of the real estate industry. Giving back to his clients is what brings him the biggest sense of accomplishment. And he's here today to talk about cost segregation analysis in this rapidly changing landscape. Welcome to the show today, Isaac.
Thank you so much, Bobby. It's a real privilege for me to be here today and to talk to your audience. And I thank you for that.
Yeah, absolutely. It's great to have you here. And I'm looking forward to kind of diving in. But, first, I'd love to give you the opportunity to just tell us a little bit about yourself. How did you get involved in real estate and what's your background? Absolutely.
So I grew up actually in the Midwest, in Detroit, Michigan. And as a kid, the personality that I realized I had was a go-getter personality. So I started off mowing lawns, making all that side money that every kid loves to do. And as I transitioned from a young kid into a young adult, through my school years, I always took along that go-getter personality. I remember when I was in school, I used to give my friends haircuts to make some side cash. And then I finished up school. I went to work. I actually managed a high-end clothing store in Central Jersey.
I was wondering, the accent did not sound like a Michigander. So I just had to throw that out there. Anybody listening, it was probably a little bit confused there. So
I've been out of Detroit for 12, 13 years. So it's been a while. I've been on the East Coast. So I guess it's rubbed off a little bit.
Yeah.
Anyways, I was in this clothing brand, and we did some great stuff there. And I actually was getting paid pretty well. And I had sat down with a friend of mine, and we were talking about real estate. And he said, "Listen, Isaac, you could continue with what you're doing, and you can make a decent living, and life will be great. Or you can enter the real estate space and really do some incredible things." Obviously, there's so many different avenues and spaces in real estate, from syndicating to capital raisers. Everybody has their niche where they could go ahead and provide. So I met with a few people, and I was introduced to this wonderful company, Madison Title. Madison Title is a company that actually has 800 employees. We have offices in Texas, Ohio, New Jersey, New York, and then we have out of country as well to run operations while everybody else sleeps. So it's really an incredible company that gave me an opportunity to start my real estate career. Doing title really transitioned over to COSEG as well, which they have under one roof. So we're a COSEG company, 1031 due diligence and title, nationwide. And what's incredible about what I do is that I really have the opportunity to go ahead and meet so many different people from all different sectors of the real estate space. So I meet with people that are closing $300 million deals to people that are closing $100,000 single family rundown properties. So between title and cost segregation, that's enabled me to do that. But I could have stopped there. I could have been a regular sales rep and said, hey, let me sell cost seg, let me sell title, and I'll be good to go. But I decided no. I love helping people. I love connecting people. And I decided that I'm going to go all in over here. I started reading books, listening to podcasts, going to conferences, going on to virtual meetups all the time, and started learning more and more and more about the real estate space. And that actually has helped me tremendously to give back to my clients, because if I know what a cap rate is, and if I know what a 1031 exchange is, and if I know the difference between retail development, multifamily, single family, the advantages and disadvantages to every single asset class, I could go ahead and actually help my clients on a personal level and show them and provide for them in a way that so many other salespeople cannot. So by doing that, by going to these conferences and going to these meetups and hosting my actual own personal meetup every single Tuesday, which is called Tuesday Connections, that's enabled me to learn so much about the real estate space and actually go ahead and meet and create relationships with people that would have been impossible without. And I'm full of gratitude towards my company, towards the system, towards every single person just like you, Bobby, and everybody listening to this in the real estate space that's provided me this opportunity to go ahead and offer what I offer. Again, what I offer is not just in terms of cost seg or title. What I offer is in terms of being there for you and helping you out. Anytime I see on LinkedIn somebody post off-market deal, I'll tag one of my people that I know is looking in that specific area. So I really try to go ahead and give back. And I'm really super excited for the years to come and to see what else and how I will transition into a bigger role, to start syndicating deals possibly down the line. So God willing, everything will be great.
That's cool, man. Well, and I'll definitely put the link for your Tuesday Connections meetup into the show notes so that people can, get a hold of you that way as well. But you kind of provided a good segue there. You're talking about this company. Title stuff is pretty highly regulated. So what is it that, what does it matter whether you choose one provider or another? What is the difference between providers that you've seen being directly involved in the business? Have you seen, obviously you've seen the good and the bad, but what are some of those major differences that people can look out for?
That's a great question, Bobby. People ask me on the phone all the time. They say, hey, Isaac, you sound like a nice guy. Well, what makes you better than my current provider? They're doing okay. So it's really what I talked about previously just now when I talked about giving back. I'll get to the giving back in a moment, but what I do want to touch on first is in terms of Madison Title as a whole. Madison Title as a whole, because they're so accomplished, they're able to go ahead and close a deal in an efficient and smooth manner that some companies sometimes have a harder time doing. And the reason why they're able to do that is because they've been around for so many years and they've done every single transaction type. If you have a smaller firm doing title work, sometimes a property will come to them to go ahead and perform title insurance on. And they're like, hey, we never dealt with such a property in such an area. We have to start from scratch, figuring out exactly every single nuance and every single detail, how to move forward with this. Because we're so familiar with every single angle of the real estate space, that right there provides a step forward in the right direction for us. Clients have told me many times that they've been with other firms, and I will never, ever put down another firm because there's great firms out there. But they said they've been with other firms and they never have ever seen such a smooth process in terms of title, which our company is able to provide. But something even more than that, because our company allows, I wouldn't say the word allows, because our company provides everything under one roof, which is cost seg, 1031 due diligence. We're actually able to go ahead, instead of going to one company for title, one company for cost seg, everything is done in-house, and we could just pass it on to the next team, instead of starting to resend the documents, resending the closing statements, resending the appraisals. So in terms of smoothness and being able to get the job done in an efficient manner, that definitely gives us an edge. In terms of client relationships, we are extremely careful and particular about client relationships. We will go above and beyond to make a client happy. There's been many instances that deals have almost fell through, and we have come in right underneath and put up money and have done stuff in different specific areas that have helped made the deal go through in which a regular situation it would have fell through. So we've helped out clients that have come to us either for title or cost seg to do so many different things. We've hooked up equity for them. We've hooked up deals for them. We hold a conference in Miami in the St. Regis every single year in the winter. And we bring our clients in and we introduce them to other people that they could go ahead and partner up with possibly. So we believe in that motto, and I personally believe in that motto tenfold. The motto of the more you give, the more you'll get. We try to be there for our clients. So to make a long story short, just in a nutshell, what I think and I know that our company can provide is the integrity. Everything is done very honestly over here. We will not overpromise and underachieve. We underpromise and overachieve. We've lost clients because of that sometimes, but we will never, ever say something if we cannot do it. On top of that, the smoothness and the efficiency. And then last but not least, our biggest selling point is the relationships that we provide and the care that we do take care of our clients.
Cool, man. Well, I want to get into a bit of the meat here. Let's start talking about cost segregation. A lot of people have heard the term, but not as many people know what it is. So can you kind of give us a quick overview of what cost segregation analysis actually is?
Absolutely. Cost segregation is an incredible tool that every single real estate investor, big or small, has to know. And the same way every real estate investor knows what a 1031 exchange is, that's the best way to defer your capital gains by throwing your proceeds into a new property when you sell the previous one. The same is true for cost segregation. Cost segregation is a way to accelerate your depreciation. So every single time you buy an investment property, you're entitled to full depreciation on your property, which means your accountant every single year will give you a little bit of your purchase price back in tax write-offs. Cost segregation was introduced in order to help real estate professionals like me and you to accelerate the depreciation and enabling them to offset their tax liability, giving them more cash flow to reinvest elsewhere that they wouldn't have had access to. So the way I always put it to my clients, I say like this: if I owed you $100, what would you rather? Would you rather that $100 over 10 years, or would you rather it in year one? Obviously, the answer is year one, because now you got extra money to buy some extra items and resell them at a higher point, whatever it could be. Obviously, I want more cash flow. So just to remind everybody, cost segregation was around for years and years. In 2017, Congress introduced a new caveat. I wouldn't say caveat. A new point in cost segregation. A new way to make it a little more exciting for us. And that was bonus depreciation, which means it used to be cost segregation enabled you to switch from 39 and 27 year to 5 and 15 year property, to be able to identify 5 and 15 year property within your 39 year and 27 and a half year depreciation cycle. But that only got you your depreciation on a faster cycle in terms of 5 years and 15 years. In 2017, it was introduced that you could get bonus depreciation, which allows you to take all 5 and 15 year property on year one. So in short, If you would buy $1 million property through bonus depreciation, you actually can go ahead and get close to $200,000 on year one as a tax write-off, which is incredible for you, your partners, your investors, and anybody else that's involved in the deal.
So let's dive a little deeper though, because cost segregation, it sounds like a really cool thing. What is it that you're doing when you actually perform a cost segregation analysis? What is it that happens when you go to a property and you say, hey, I'm going to do your cost seg today? What happens?
So that's a great question, Bobby, and I think this is very important for the audience to really understand how this works. Many clients ask me, why can I do it? Why can my accountant do it? My accountant does my regular depreciation. The answer is a regular accountant is not familiar enough how to segregate and identify different components in the property. Therefore, if the accountant does it himself, the numbers that he will get are going to be very, very minimal. As opposed to us or any cost segregation firm, they'll come in with an engineering team. They'll go into a property. Let's take a multifamily property. And they'll say, hey, there's carpet here. Carpet is 5-year property. There's chandeliers here. Chandeliers is 5-year property. There's land improvements, parking lots and pavement and grass and bushes and trees that you put in. That's 15-year property. That's land improvement. So that's something that regular accountants cannot do, and they're not familiar enough to be able to segregate properly. We come in, perform the study, and on a fair charge, on a fair price that we can go ahead and allow our clients to really to go ahead and give our clients the best price possible to go ahead and perform a study and give them this tax write-off, which they would not be entitled to if not for an engineering team coming down and performing an on-site study.
So I'm going to put this together and you can tell me if I'm right or wrong. Okay. So basically you guys come into a property, you say, hey, you know what? There's, like you said, there's carpet that's depreciable over 5 years, and there's appliances that's, let's say 15 years. There's the roof that's, 15 or 20 years, whatever the case may be. These are all depreciable assets that you can depreciate over time. Now, a normal residential home is 27 and a half years that you depreciate that over that time period. So it's small amounts in every year. But what you're saying is that with bonus depreciation, you can take that whole kit and caboodle and you can take that depreciation all in the first year.
Right. You're not going to be able to take the entire purchase price.
Gotcha.
But all the 5 and 15-year property, which usually makes up 20% in a multifamily, you'll be able to take that in year one, which is incredible.
Gotcha. So if somebody, let's say they invest $50,000 into an apartment syndication, how much of that would show up as a paper loss? And how does that differ from one property to another?
Great question. So limited partners gain tremendously from cost segregation. And the reason being is like this. Let's say, Bobby, you would go ahead and you would syndicate a deal. You would syndicate a $10 million multifamily deal. Minimum investment is, let's just make it really simple. Minimum investment's $1 million. Obviously, that's not the case. Usually, minimum investment's $1 million. Basically, in short, if you're going to put up $1 million, you're going to have a 10% stake in the property. So obviously, whatever the structure is, if the syndicator decides to give you less, he'll give you less. If he gives you more, he gives you more. But let's say you have a 10% stake in the property. You'll be able to go ahead and through the equity that you have in the property, that will entitle you to 10% of the depreciation. So if you have 10%, you will get 10% of the accelerated depreciation. If you have 20, you will get 20%. So let's say the accelerated depreciation on a $10 million property would be, let's say $2 million. So you'd get, let's say 10%, you would get a $200,000 write-off. If you have a 50% ownership in the property, you will get half of that write-off. You'll get $1 million write-off. I just provided a study for a client of mine who's getting a $5 million write-off, and every single limited partner is going to be getting back approximately $50,000 of a tax deduction, which is incredible. If they made $200,000 that year and they go ahead and they take off 50, they're only left with $150,000 of income liability, tax liability, which obviously is going to result in you pay less taxes.
Now, can you apply that depreciation to regular income, or does it only apply to passive income?
Incredible question. Incredible question. A very important question. And the answer is, if you're a real estate professional, then you can apply it to regular active income. If you're not a real estate professional, you could only apply it to other passive investments. That means not only passive investments in that specific property per se, it can be done using to offset passive investments in the stock market, other K1 investments. So any passive investments. But the question is, what makes somebody into a real estate professional? And the answer to that is, if you spend 750 hours a year in real estate, or if you're working another job and you spend more hours per week in real estate than you spend in the other job, that will make you a real estate professional, enabling you to go ahead and offset active income as well. I've seen many times, Bobby, a very interesting way that people will work with their real estate is if they're married and their spouse is on W-2 income and they're a real estate professional and they're filing jointly, they can actually offset their spouse's income as well. So it's really endless and an incredible way, obviously, of offsetting your tax liability.
Yeah. Sounds like a great conversation to have with your CPA if you've not had that conversation already. So
absolutely. And I just want to throw this in, Bobby,
yeah, go ahead.
over here, is that everybody listening to this should know, if you own real estate and your CPA has not told you about cost segregation, it's time to find a new CPA, because there's so many CPAs out there that do not inform their clients about cost segregation. And it's an extremely important component to know if you own real estate. Extremely important.
Now that leads me to my next question, though. There are a lot of people who listen to the show that have single family homes. And, the idea that is kind of passed around with cost seg is like, well, it just doesn't make sense for single family homes. It's more for multifamily because it's cost prohibitive. So is that fact or fiction? And where is the line drawn there?
Great question, Bobby. You're really hitting every single point on the nail over here. And I'm excited to share again exactly the difference between single family and multifamily and where you do draw the line. So clients as well ask me this all the time. I only have single family. It's probably not worth it. I'm like, hey, I draw the line by $400,000. If you purchase a property for $400,000 and above, it is 100% worth it for you to speak to a cost segregation expert like me or anybody else and crunch the numbers. Because just on a $400,000 property, single family property, you can get back sometimes close to $70,000 as a tax write-off for a price tag as low as $3,500 for a cost seg study.
$3,500.
Yeah. Because
holy smokes,
for single family houses, we generally charge much cheaper, as opposed to multifamily that averages out at $5,000 for a study. So if you purchase the property for $400,000 and above, it's definitely worth it to reach out to somebody. If it's under $400,000, this is what I'll say. Most of the time, it's not worth it, because if you crunch the numbers, the write-off is not going to be so large. So therefore, what you're paying to get the study done and the write-off that's really being given to you is not going to really be well worth it for you. But I went ahead and just did a study for a client of mine who had 250 single family houses in Philadelphia. Each house was purchased for $100,000. We were able to perform for him a systematic study, which means we're able to do it on a few houses because they're all very similar, and provide a great price for the entire portfolio. We got him north of a $5 million write-off. So you don't need 250 single family houses to do this. I have a client that will be sending me 30 single family houses that were purchased for $100,000 each. And I will be doing a study for him, entitling him to a big write-off in order to help him out in 2021 taxes. Right now, he's on extension. So the idea is, if you have multiple single family homes that were purchased for less than 400, if they are similar style houses, it doesn't hurt to make that phone call. We're not scary. We'd love to help and walk you through the process. Is it worth it? Is it not worth it? But in general, if you only have one or two properties, I'd say the cutoff point is $400,000 for single family. Because single family, there's a lot of items in the property that can be depreciated faster. There's carpet, there's parking spots, there's chandeliers, there's vanity. Single family is a great asset type.
So what it sounds like is that it's more dependent on the value of the property more so than the amount of doors that it has. Right?
Exactly. Exactly.
Okay.
But I will add in, it's very good for all real estate syndicators and investors to know that there are different percentages that we project on different asset types. And I'll just go through them quickly. Single family houses generally will get anywhere from 15 to 20% of a write off the purchase price in year one. Multifamily will be anywhere from 20 to 30% on year one because there's a lot more tangibles in multifamily. That's what we've seen over the years is bigger parking lots, more landscaping, etc. Um, the next asset class I'll go to is industrial. So warehouses are not the greatest asset class because they're generally very empty on the inside. So there's not too many tangibles inside that property. But if there's a big property, if there's a big parking lot, and there are expensive HVAC that was put into the property, that could definitely be a deciding factor in how much you'll get. I will say industrial will range anywhere from 12, 13% to 15, 16%. And then retail, which is like shopping centers and regular stores that you may buy and rent them out, they'll get anywhere from 15 to 23%. And then the last two is something that you might want to turn your ears on for, guys, is mobile home parks are extremely beneficial when it comes to cost segregation. You could get anywhere from 40 to like 75% of your purchase price back because there's so much throwaway items. The whole idea of accelerated depreciation is 5 and 15-year property, which is going to go bad. So in mobile home parks, there's much of the property is items that are going to go bad over a fast period of time. So you could get back sometimes up to 75% of mobile home parks. And the last but not least is a secret that many people do not know is car washes. Car washes are entitled sometimes up to 90% of bonus depreciation. That means, guys, if you would buy a car wash today for $1 million, land is not depreciable. So let's say we take off 10% for land. We'll go down to $900,000. If you get 90% of $900,000, that's incredible. That's basically writing off everything that you have, plus it will carry forward because it never goes away. If you go ahead and you do a cost seg study and all you need is some of it and not everything, it will carry forward on your tax returns, on your K1s, and it will go forward to the next year if you need another write-off.
I really appreciate you mentioning that last point because that was going to be one of my next questions was, how long is this good for? And what you're saying is that you essentially you can use these paper losses for as long as you have the property and as long as you still have some left that you haven't used, right? So that's awesome, man. I really appreciate you getting into detail there. Are any of these provisions that we're talking about, how long do we expect them to actually last? Are they going to expire at any point? Or, I've heard those kind of whispers about bonus depreciation. What can people expect to see in the future?
Absolutely. It's a very, very good point, Bobby, because as of now, Congress does plan on phasing out bonus depreciation slowly. In 2023, they're phasing it out from 100% bonus to 80% bonus. And then 2024, 60, and every year another 20% until bonus completely phases out. I personally believe it'll never be completely phased out due to the fact that we have different Congresses and different parties coming in, and they always could go ahead and switch things up. But 2022, this year, is actually the last year for complete 100% bonus depreciation. Take advantage of it. Do as many properties as possible. Carry it over to the remaining years. You'll be good to go.
Yeah. So this is the year. This is the year that you want to get some stuff done. If you've ever wanted to invest in real estate, now is the time. So
exactly.
I know we're running out of time here. I love that you mentioned mobile home parks. I've got a guest in the future coming on to talk about mobile home parks. So that fits right in. Awesome. But yeah, man, this has been fantastic. I do want to give folks a chance to get a hold of you if they'd like to learn more about you or your company and learn more about the services that you guys provide. So if you wouldn't mind, just let the listeners know how they can get a hold of you.
Absolutely. So yes, I would love to connect with each and every one of you. I am the most active on LinkedIn. So it's Isaac Weinberger. I call myself CostEgg Isaac. I host Tuesday Connections on Tuesday with speakers every single week. Sometimes it's actually just networking, but many times we have speakers. Great networking, syndicators, brokers, investors. And find me on LinkedIn. All my information is there. And I'd love to talk to you and just give you a rundown on a personal level, exactly the ins and outs of title, of cost seg. I'd love to connect.
Yeah. And tell me about that website for your company, if you would.
Yes, the website is madisontitle.com, and you can find everything there. There's actually different websites for the different sister companies, but I'm assuming, I think in madisontitle.com itself, you'll see there's Madison Title, there's Madison Specs. You'll see everything there.
Okay. Very cool, man. Well, hey, this has been great.
Bobby, this was awesome.
I really appreciate you being here today and sharing your knowledge. And, I hope more people reach out to you as a result of this conversation, because it sounds like there's a lot of people leaving a lot of money on the table. I hope that you learned a few things from Isaac today. I know that I sure did. And I always enjoy exploring all of the benefits of real estate investing. The big thing for me was learning about how cost segregation can apply to single family and small multifamily homes. I really hadn't considered where that line was drawn, and I thought it was more a matter of commercial versus residential real estate. But that $400,000 marker is a great one to keep in mind. I know that there are plenty of listeners out there who own single family homes or duplexes that top that $400,000 mark. It may be worth it to you to reach out to a cost segregation specialist like Isaac to see if you're leaving any money on the table. Now, in case you were wondering, we do still have some slots available in our drug rehab center offering. Like Isaac said, this is the last year for 100% bonus depreciation. So even if you don't invest in this offering, you should definitely be keeping your eyes peeled for others before the year ends. That's going to do it for the show today. If you enjoyed this episode, I hope you'll leave a 5-star review and invite a friend to listen. That's exactly how we grow and have more influence with our show and just reach more people. Until next time, though, be safe and take care of each other out there. Thank you so much for joining me for another episode of the Plan B CRNA podcast. If you haven't already subscribed and reviewed the show, I'd be honored if you took the extra time. It really helps to expand our reach and get the word out about the show. If you're a CRNA who is interested in sharing your story on our podcast, I'd love to have you. Please email me at bobby@oncallinvestments.com for more information. This episode was brought to you by On Call Capital. They are dedicated to helping providers like you develop passive income and generational wealth through investments in the apartment and alternative investment spaces. Feel free to check out their website at www.oncallinvestments.com and subscribe to their free educational email series. You can find On Call Capital on Facebook, Instagram, and Twitter. You can also check out our YouTube page, where you'll find all of the show episodes along with other educational videos. Thanks for listening, and we'll see you on the next episode.